friends, let's talk rates. I listened to a guy named David Stevens on March 13th, and it was a recording. I don't know how old the recording was at the time, but I'm guessing this information is probably from March 1st or something. So it may be a month old at this time, but I wanted to share the information anyway because things may have changed, things may have not changed. I don't know, but it's information nonetheless, and I think you could benefit from it. So David Stevens is a mortgage consultant guy. He's CEO of a lot of things over the years. One of those is Mortgage Bankers Association. He was COO of Long Foster. It's a real estate company. And he was Assistant Secretary of Housing on Obama's administration. So he's got quite the resume. He is well versed in his knowledge, and he's been in the housing and mortgage industry for a very, very long time. So his information is legit. I really was fascinated by his knowledge and confidence in what he spoke about, so I was impressed. Anyway, the big hitter information I just want to share with you. So the first thing he really pointed out was that rates have not been below 6.25 except between 2008, 2009, and 2022. So basically during the Great Recession. Historically speaking, that means that most of the time rates were above 6.25, and that's approximately where we are right now. We're just kind of hovering around there. You might see a 5.75 rate out there, depending on the lender you go to, depending on the day, because they fluctuate from day to day. So 5.5 or 5.75 to 6.75, I would say, is a decent range for our local area currently. Hopefully on the lower side for you, but it depends on a lot of things. So historically speaking, rates have only been below 6.25 from 2008 or so to 2022. They went up in the fall of 22. So just last October, they rose a great deal above that threshold anyway. So we have been really spoiled with rates in our generation from 08 to 22. Really spoiled with low rates. That is amazing, and we like it. Now it's hard to get used to these higher rates, but historically speaking, they are completely normal, you know? So that's one thing I wanted to point out. He also had some rate predictions. So he's predicting that mortgage rates are going to go down to 5.4% by the end of 2023. So that's this year. We've got several months yet to work that out, but he's expecting them to go down. He's also expecting them to go down to 4.5% by the end of 2024. So that would go down even more. There are things that happen in the news every day that might impact these things. And like I said, this information could be about a month old, but I wanted to share it anyway because there's some good stuff in here regardless of what the predictions are. So remember, these are not my predictions, those are his predictions, but nobody can predict the future, so do not bank on these things. This is just potentially could happen kind of stuff. So, in 2023, he's expecting it to be the third or fourth best year in the last 20 years, and he's expecting 2024 and 25 to be super strong years in real estate as well. Now, I didn't get the details on what he meant by the best, because that's kind of an ambiguous statement, but I think a healthy, strong market with fast-paced, lots of buyers, lots of sellers, lots of transactions happening. So that's what I interpret that to be. You might have a different interpretation. If you do, let me know. We can talk through it, so see if we can learn something from each other. All right, and then the last thing you pointed out was what buyers and sellers should know. So one of those is that home ownership creates wealth. Yes, indeed it does. So the sooner you can get out of renting, the faster you're going to be able to build your financial stability and wealth. So that home equity that you gain really goes a long way. It makes a very big difference in your wealth accumulation. He also wanted to point out that when rates go down again, the competition will get fierce again. So the last couple years we've been in fierce competition. Rates were low, there were plentiful amounts of buyers and sellers, and there were, well, not as much sellers actually, just lots and lots of buyers with not enough homes to pick from. Therefore, we got 6 or more offers on every home. And those conditions meant high prices, so buyers were paying a lot more for homes than what they might have been worth at the time, and they were also having to give up anything that they wanted in the transaction. So they had to forfeit any repairs, they had to pay their own closing costs, things like that. They didn't get any concessions from the sellers. So when rates go down, competition gets more fierce and you don't get as much as you want as a buyer typically. So his point was, now is the time to buy, because high rates and less competition versus low rates and tons of competition. So when there's high rates and less competition, you might not get what you want right now in regards to the rate, but rates will go down at some point most likely. So you can always refinance when that time comes along. So there's the expression that they say, marry the house, date the rate. So you might have a high payment for now, but in a few years when rates lower, you can get a much lower monthly payment if you refinance. So versus the low rates and tons of competition, which we talked about already, where if you have so many buyers trying to fight over very few homes, you are going to have to pay a lot and not get a lot of concessions from the seller. The seller just has to go eeny, meeny, miny, mo. I want this highest offer because that serves me best. So those are the points that I wanted to call out from Mr. David Stevens. I thought he made some really great points, and I thought that my clients would benefit from knowing that information as well. So if you guys have any questions, I'm happy to talk through those with you. You know how to reach me, call, text, email. My info is on my page here. So thanks for listening, you guys, and let me know if you have any questions. Bye.